Welcome viewers, today we are going to cover the statement of profit or loss and other comprehensive income from the Financial Reporting FR ACCA question paper. Let's go there now. We have the question paper here with us, Applied Skills Financial Reporting, September-December 2018 sample questions. We are going to cover question number 32. Now let's scroll there. We are going to cover question number 32. This is question number 32. Let's go to the required. We have the required here. Prepare a statement of profit or loss for Duggan Co. for the year ended 30 June 20x8 for 12 marks A. B. Prepare the statement of changes in equity for Duggan Co. for the year ended 30 June 20x8. C. Calculate the basic earnings per share for Duggan Co. for the year ended 30 June 20x8. Today I'm going to solve only required part A. Prepare the statement of profit or loss for Duggan Co. for the year ended 30 June 20x8 for 12 marks. In this question, I want to demonstrate how easy this question can be, and also I will be talking through the exam techniques along the way when we are solving this question. Now let's go to the required. Let's go to the scenario. We are given the scenario, we are given a trial balance there. Then the first point, if you are given a trial balance and you know that you are supposed to prepare the statement of profit or loss and other comprehensive income, it is advisable that you open the required accounts. That is, you open up the template and fill the template with everything that is on the trial balance. I've gone ahead and prepared the template. So what we are now going to do, we are now going to take everything from the trial balance and pop it up into our template. Now let's go to the trial balance. Convertible loan notes. The convertible loan notes, they do not feature in the statement of profit or loss. They only feature on the statement of financial position. So we are not taking that 5,000 in thousands. Cost of sales. The cost of sales, they do appear in our statement of profit or loss of 21,700. So let's go to our statement of profit or loss. We open our bracket, we say 21,700 like that. We go and check another figure there. Finance cost of 1,240. They do feature in the statement of profit or loss. So let's go where we are given finance cost. Let's work it out. 1,240 like that. Then investment income of 120, that's a statement of profit or loss item. So we go here 120. Let's go again. Operating expenses. Expenses go through the statement of profit or loss. How much was it? 13,520. So we come to our statement of profit or loss, we say 13,520 like that. Then retained earnings, they only affect our statement of profit of financial position. So we're not taking that 35,400. Revenue, indeed we are taking revenue, 43,200. We go to our revenue, we say 43,200 like that. Equity share capital, this does not affect the statement of profit or loss. It only affects the statement of changes in equity and the statement of financial position. tax, we have got 130 credit. If we have got a credit, it means we have over provided in the previous period. So if we have over provided, it means we have allocated too much expenditure in the previous period, so we have to reduce the current expenditure, which is the current tax. We have to subtract the 130. So we have to subtract the 130 like that. Now we have taken everything from the trial balance. Now let's go to the notes. Note number 1. DCO entered into a contract where the performance obligation is satisfied over time. The total price on the contract is 9 million with the total expected costs of 5 million. So this is the contract price and these are the expenses. So what you have to do first, you have to determine whether this contract is profitable or not. So we say contract price less the cost, we get 4,000 profit. So 4 million profit. So this is profitable. So if it's profitable, we are not going to recognize the profit in a single period. We have to split the profit throughout the contract period. Now let's go ahead. We are saying progress towards completion was measured at 50% at 30 June 20x7. This was the previous period where 50% of the contract was completed and 80% on 30 June 20x8. So as at this reporting period 30 June 20x8, the progress on this contract is now 80%. But previous period we have already recognized 50% of the contract. So it means from the previous period up to this period. So this period we only recognize 30% of the contract as the 50% was already recognized. So we say 80% minus 50, we get the 30%. So in this current period we have to recognize only the 30% of the contract. The correct entries were made in the year ending 30 June 20x7. That was the previous period. But no entries have been made for the year ended 30 June 20x8. So the 30% that is progress during this period is not yet recorded, so we need to record it. So the contract price, we record the contract price, 30% of it as revenue, and the total expected cost of 5 million, 30% of this 5 million is cost of sales. Why 30%? Because we have already recognized 50%, so the current period, the cumulative is 80. So we say 80 minus 50, we get 30%. Now let's go and do just that. So under revenue here, we will add revenue of 30% multiplied by 9 million. 9 million becomes 9,000. Under cost of sales, we will also add 30% multiplied by the total expected expenses is 5 million, which is 5,000. Why 30%? Because we said cumulatively the contract progress is 80%, but in the previous period we recorded 50%. So 80 minus 50 is 30%. Now let's go to note number 2. On 1 January 20x8, DCO was notified that an ex-employee had started court proceedings against them for unfair dismissal. Legal advice was that there was an 80% chance that DCO would lose the case and would need to pay an estimated 1.012 million on 1 January 20x9. So this lawsuit, we have to pay it after 1 year from the beginning of the year. So what we need to do, we need to discount this payment to present terms. So based on this advice, DICO has recorded a provision of 800,000. Why 800,000? DICO has said 80% of 1 million and got 800,000, of which this is incorrect, and has made no further adjustment. The provision was recorded in other comprehensive income. So this 800,000 is wrong. We need to go and subtract it from operating expenses. So we'll come here and remove the 800,000, which is 800 in 1,000. Then we have to calculate the correct expected value of the present value of the payment. So what we are going to do, we are going to say provision. The provision is for 1.02 million. Let's go and take the figures there. We are told DICO has a cost of capital of 10% per annum, and the discount factor for 10% for 1 year is 0.901. So we need to discount this estimated pay to present terms. So simply multiplied by the discount factor for 1 year, we get 920. So the company should therefore charge the statement of profit or loss by 920, not the 800. So we have reversed the 800 and charged the correct figure there. But if we discount, we need to unwind the discount. Unwind the discount. So let's unwinding the discount. So if we unwind the discount, let's take note here. Our year end is 30 June 20x8, but we will unwind the discount for only 6 months, as we recognized the provision on 1 January 20x8. So we say January, February, March, April, May, June. That's 6 months. So we unwind the finance cost for 6 months. So we say 920 multiplied by 10% multiplied by 6 out of 12. So we only unwind 46. We have got the finance cost of 46. Let's go here and add 46 like that. Let's continue. Note number 3. The balance relating to tax in the trial balance relates to the under or over provision from the prior period. We have already dealt with this 130 as the over provision. Now we are told the tax estimate for the year ended 30 June 20x8 is 2.1 million. So the current tax is 2.1 million. So we come here where we have got our tax, we add 2.1 million, that's 2,100 as the tax expense for the year. Let's continue. In addition to this, there has been a decrease in taxable temporal difference of 2 million in the year. Duggan Co. pays tax at 25%, and the movement in deferred tax are taken to the statement of profit or loss. So we have got a decrease in temporal difference of 2 million, and the tax rate is 25. So we have to calculate the deferred tax. This is a reduction in deferred tax. So it's a reduction, it's a subtraction or a reduction in the expense. So we'll say minus 25% multiplied by 2 million, like that. 25% of 2 million, that is the deferred tax movement. Let's continue. Item 4, DCO issued 5 million 6% convertible loan notes on 1 July 20X7. That was the beginning of the year. Interest is payable annually in arrears. These bonds can be converted into one share for every $2 on 30 June 20X9. So it will be this, they will either be converted or redeemed on 30 June 20X9. That is 2 years, 2 years after they were acquired, they were issued. Similar loan notes without conversion rights incur interest at 8%. This is our effective interest rate that we use to get our finance cost. And also this is the rate that we will use to discount, not the rate that is the coupon rate that is on the loan notes. DCO recorded the full amount in liabilities and has recorded the annual payment made on 30 June 20X8 of 0.3 million in finance cost. So this finance cost is wrong because now DCO has recorded the installment as the finance cost. So what we are going to do, we are going to reverse this finance cost of 0.3 million. So we'll come to our finance cost. We will subtract 0.3 million is 300. We will subtract 300 and add the correct figure in due course. Now, let's go and do the calculation. We have interest. How much is interest? Interest is 6% multiplied by 5 million, that is 5,000, like that. So we will pay interest for the year ended 20X8 and also for the year ended 20X9. So we'll pay interest for 2 years and also we will pay the principal of 5,000 at the end of the contract period, which is 30 June 20X9. So now we need to discount this. Why are we doing this? As this is a convertible loan note and is issued, is be carried at amortized cost. So now we'll have to split it between equity and the liability component. So by splitting, we have to find the present value using the effective interest rate. Then we subtract to get the equity, which is the residual. Now, for the interest, as I said, we will pay the interest in 20X8 and 20X9. So we'll pay the interest for 2 years. So we will use these discount factors. For 1 year, 88% is 0.926. For year 2 is 0.857. So we'll pay interest twice. So we'll say equals 0.926 plus 0.857 for year 2. We get that. That one is an annuity factor. Then we multiply the interest multiplied by the discount factor. Then again, here we will use the discount factor for year 2 as the principal will be paid in year 2. We get that, then we sum. Summing this will give us the opening liability If we want the equity component, the loan acquired was for 5 million, so we'll say 5 million less the liability. So the equity component will be 180,000. Now we have to have our finance costs. We will use the effective percentage of 8%. So we'll say our liability multiplied by 8%. We get 386. So the 386 is the true finance cost. So we have reversed the 300 and we put the correct finance cost of 386. Now the installment that DCO will be paying will be based on 6% of the nominal value of the loan. So DCO will be paying 6% multiplied by 5,300. Then if we sum here, we will have our closing liability as at 30 June 20x8. Let's continue. Note number 5. DCO began the construction of an item of plant on 1 July 20x7, that is the beginning of the year, which was completed on 31 March 20x8. A cost of 32 million was capitalized. This included 2.56 million being a full 12-month interest on a 25.6 million 10% loan taken out specifically for this construction. The borrowing costs are covered by the standard IAS 23. So the borrowing costs are only capitalized when the asset is being constructed. After the asset has been completed, the capitalization of the borrowing costs or interest should cease. So the capitalization of interest was supposed to be ceased on 31 March 20x8. But DCO did not do that because he capitalized for the whole 12 months. Whereas he was only supposed to capitalize for 9 months, as after the completion of the asset, it's April, May, June. So the 3 months was not supposed to be capitalized. So this 3.5, we need to take it off from the asset and expense it. So the 2.5 million, we have to take 3/12 and expense it as a finance cost. So we come down here, we say excess finance cost. So the excess finance cost that should be capitalized, we agreed is 2,560 was the total interest. Then we multiply this by 3 out of 12. Why 3 out of 12? Because April, May, June, the asset has already completed, so this should not be capitalized. So we come and add it here under finance cost 640. Also, this affected depreciation. So there is excess depreciation that was charged. So we need to reverse the depreciation. The depreciation that was charged was for 3 months. So we'll say 640 multiplied by 3 out of 12 multiplied by 1/20. Where am I getting the 1/20? We are told here that on completion the property had a useful life of 20 years. So if it is a useful life of 20 years, so it means this excess finance cost should be divided by 20 years and multiplied by 3/12. We get 8. So this excess depreciation was charged to operating expenses. We come and subtract it like that. Let's continue. Note number 6. It has been discovered that the previous financial controller of DICO engaged in a fraudulent financial reporting. Currently, 2.5 million of trade receivables have been deemed not to exist and requires to be written off. Of this, 0.9 million relates to the current year, with 1.6 million relating to the earlier period. So this 1.6 will be a prior period adjustment when we are doing the statement of changes in equity, but we are not doing it today. We only consider the current fraud of 0.9 million that we need to add it to our operating expenses. The fraud for the financial controller, we are writing it off 0.9 million like that. Now, on 1 November 20x7, DICO issued 1.5 million shares at their full market price of $2.20. The proceeds were credited to the suspense account. We are not doing this as this relates entirely to question part C. So we are not touching that. So we have finished everything that we are supposed to do on this question. Now we have to tidy up by adding across our statement of profit or loss. So revenue, we have got 43,200 plus 30% multiplied by 9,000 like that. Then our cost of sales is that we add onto that 30% of the expenses. We get that. When we sum together, we should get our gross profit. Our operating expenses is 13,520, out of which we reverse 800 and add the correct finance cost. We reduce excess depreciation. We add the fraud. Then our income did not change. Then our finance cost, we have got 1240, of which we add the 46, we subtract the 300, we add the 386, we also add the 640, like that. Then when we sum here, we should get the profit before tax. Then our tax, we've got 130, of which we take it off from 2.1. We also have got the deferred tax. Then we sum up that to get the profit for the year. This is what was expected of us in September, December 2018 question Duggan call. Please watch the video till the end. Please do not forget to like, subscribe and share. Thanks for watching.